Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in investment real estate, especially new construction. Right now, and I've talked about this in a couple of videos that I've done previous to this about interest rates. You know, from September, where we thought things were going to be fantastic again, that we're going to have happy days at 5% fixed for 30 years for investors, oops, that hadn't happened. If I looked at rates last week with an interest rate buy down, they were 6.375% for a Fannie Mae 30-year fix for investors. Now that's higher than it's been for about the last 30 days at least. Now, it's kind of fluctuating back and forth. The 10-year Treasury, the bond market spoke last week about what they see about upcoming policies with the new administration, and they're kind of hedging their bets. We'll have to wait and see in the next couple of weeks just how serious these policies are that might affect inflation. But the whole point is even if it's 6.125, 6.25, 6.375, you've got to pay points, all right? And these points are made off a par rate. Now, what a par rate means is I don't want to pay anything extra to the lender. And so I'm going to accept, instead of a 6.25, a 7.125% fixed rate. Now, if you do this as an investor, you're in big trouble because just about anywhere in the United States, it's going to be negative cash flow. So you're going to do an interest rate buy down. So let me tell you how this works. So lenders have to borrow money at a particular rate, right? And they're going to make a profit and they add on to that. So if it's 7.125, that's fine. What they're looking for is the fact that you're not going to hold your property and pay off a mortgage in 30 years. You're probably going to be moving, all right? Or, you're going to pay it off early. So what the bond market does, or what the mortgage-backed security lenders do, is they figure, well, we got to equalize a 10-year yield. If we're going to give a lower rate, we're going to have some money coming in because we want to take that money and invest it so that after 10 years, we're in the same rate, the same return as the 7.125. So 6.25 or 6.375 is 3.5 points. Now let me tell you how points work. But before I do that, I want to talk about Fannie Mae loans for investors. It is okay for anybody who owns a property, including a builder, to give you a 2% closing cost allowance. So let's take a $300,000 home, for instance. $300,000 home, 2 points means you're getting $6,000, okay? That is the maximum. But points for an interest rate buy down are not based on that. They're based on your mortgage amount. So let's say you're putting 20% down. It's kind of easy for me to calculate. That's $240,000. Now, most investors right now are putting 25 to 30 down, but let's use this as an example. So if you have, say, 3 points that you've got to pay on $240,000, then it's what? $7,200, okay? And you're getting $6,000. What that means is to get the lowest rate that's being offered by the lender, you got to put out about $1,200. Now, how do we justify that? What I typically do is I compare the 7.125 to, say, the 6.25, and I take the difference in what your payment is going to be, and I calculate how long it takes for you to get your money back. But if that's 3 years or less, it's golden, guys, because it's a 30-year fixed rate. And remember, if it's 3 years or less, you've got at least 27 years of that lower rate. And investors typically hold their property for a long time. Do not pay off the mortgage because it helps them, give them the ability not to pay taxes. So it's extremely important to understand how this works. We'll be happy to calculate this with you. Let us know. We'll be happy to educate you about interest rate buy downs. It's the right thing to do at this moment. And we have tremendous amount of properties with builders that will give you this allowance. So let me know if you're interested. We'll be happy to go into detail.